Hello and welcome to the High Signal podcast. Today, I'll be talking to Greg Magadini, Director of Derivatives from Amberdata, and talking about options, markets, a little bit of history, and all of the above. So, welcome, Greg.
Thanks, Sean. Happy to be on.
So, we've known each other for a while now, but maybe take us through a little bit of history. What you did before, your current position, how we eventually met. Um, take us through that.
Yeah, I'd love to kind of give you a background breakdown. My background is in prop trading. I started my professional career at a firm in Chicago called Chopper Trading. I was trading cash treasuries versus treasury futures, essentially trading the basis. That was quite the experience. Before that, I had been trading options for quite a few years at a family office and another shop in New York where I did some equity day trading. And then after chopper trading, I went to DRW and spent some time prop trading over there. And that's about the time when I discovered crypto in terms of investing in crypto. I had known about Bitcoin, I had done research in it in college, but I had never invested in it. And once Bitcoin kind of proved that it was a staying asset, the Ethereum trade was sort of the next trade. And that's really when I started getting interested in smart contracts and Ethereum development. And a lot of the folks that I worked with ended up also quitting the trading firm to build out project in the Ethereum ecosystem. And that's really when I kind of jumped into the crypto side of the world. Wait a couple years, discovered Deribit in April 2019. And with my options trading background, crypto options were like the juxtaposition of all the things, or like the apex of all the things that I love the most. I remember telling my co-founder Pat Doyle, I was like, "This is after my wedding day. This is my second favorite day where I discovered Deribit. It was like crypto and options. Always thought it was funny." So built a bunch of tools in Excel VBA. That's typically where I like did a lot of modeling and vol comparisons and stuff like that. And my co-founder had a developer background, so he decided to actually move away from Excel VBA and build out a database and hire a team and all this stuff. And then we actually built a platform, and that's where Genesis Volatility was born.
Yeah, no, that's super interesting. So, what was like, I don't know, for you, like the main interest in getting into crypto originally? Was it, simply just it's a new asset class that's, hyper volatile and niche, or was it something else?
So it was always a trade from my perspective. When I did fundamental research on Bitcoin in college, it was 2012, and Bitcoin was like $7. Um, we had me and my co-author, who now runs a hedge fund in the crypto space called Scalar Capital. We did research on Bitcoin, like what can you do with it, and we ended up like downloading Tor, going on the dark web. And it kind of like scared me. I thought I was like kind of nuts. I was like, all right, I'm not touching this. And then later, as I was trading at a trading firm in Chicago, Bitcoin had a previous all time high of $200. And this is kind of Q4 2013. And $200 is being tested again. And from a purely trading perspective, you have this brand new asset class. No one knows what this thing is worth. And it's breaking all time highs. You just have to buy that chart. There's no other way to trade that besides buying the all-time high breakout of something that no one knows how to value it. And that's what got me into actually investing in Bitcoin.
Wow, awesome. So take us through, and I'm sure some of the listeners aren't super familiar with GVOL, but take us through maybe a bit of the story with that, what it did, and yeah.
Yeah, absolutely. So when we built out the Genesis Volatility business, really what we're trying to do is we're trying to capture all the options data that goes on Deribit and then take that raw data and calibrate it into some sort of volatility surface and essentially build out a bunch of like toggles with interactive charts for modeling volatility data. At the time, there was another competitor called Skew who had crypto options data as well built on Deribit. What they didn't have was historical data. And what we wanted to do is like essentially add the new element of historical data. So you can click through time and really see what happens. in vol surface and the evolution and things like that. So that was kind of the inspiration. And then when we built out all these volatility surfaces, we essentially created like an MVP, minimal viable product, which was our GUI web app. And then we just kind of published it to the world via via Twitter, Substack, and just direct contacts that we had. And it kind of took off. And then we started really building the business around that. We reached out to the Derive team specifically, kind of get their blessing, so to speak, to make sure that, can we take your data, repackage it, and resell it, and make sure that that's a business model. And they were all for it. Luke liked the website a lot. He thought it was great. And so there was a lot of support from them to do this and do this business.
Oh, awesome. And then, well, now you're at Amberdata, so maybe step us through what happened there.
Yeah, absolutely. So we started with 3 people building Genesis Volatility. We raised an initial round to hire 2 more people, a marketing guy and a dedicated front end specialist. After raising that first round, we ended up building out for a year and needing to raise another round. So we did that and scaled the team to about 11 people. And then finally, in our 3rd year, we were approached by some investment bankers at Galaxy who, said, have you ever thought about selling? And there's a couple reasons why I wanted to. I noticed that scaling a tech team, I'm a trader. Like I've never scaled or managed a tech team. That was definitely a pain point for me. And it seemed like if we could get acquired by someone who already has a scaled tech team, that would accelerate what we're trying to do as quickly as possible. And that's when Amberdata came across our radar, did a whole negotiation, all that stuff. And ended up being acquired by Amberdata in October 2022, which was pretty much after our 3rd year in business.
I think
and now I run this business there.
Yeah, actually, so take us through like what you do at Amberdata now. So as director of derivatives, what does that entail?
Yeah, so you can kind of think of it as going from like entrepreneur when I was a CEO and co-founder at Gvol to intrapreneur, where I'm like running the derivatives data business from within the Amberdata umbrella. So Amberdata is a multi-data asset firm in terms of the crypto space, blockchain data, on-chain data, spot data, futures data, options data, all that good stuff. And by essentially acquiring us, they accelerated their derivatives offering, which was the Gvol offering. And so I just make sure to run that within the Amberdata umbrella. And so I manage the team, I manage the products, I manage the vision, and then I still do a lot of content and market commentary and things like that in order to stay relevant in terms of the brand in the ecosystem.
Oh, nice. You mentioned just thinking back now. I think we first met when you were still doing Gvol, right? This would have been 2022. So I remember you made a bunch of videos for the AMM system. I remember, how did you find out about Derive actually? Because that's always, I know, we've had team members who found us on Discord. We've had other people who just word of mouth. Just curious how you managed to find us all the way back then.
Yeah, so this was back in the day. So I know there's a team member on Derive who is in the Chicago area. So I had been familiar with that team member. So that was interesting. They made an introduction to Nick back in the day when you guys had just launched the original AMM under Lyra or Lyra and Lyra branding. Yes. Not Italian currency, Lyra, not liras. Or is that Turkish? I'm not sure.
I think it's Turkish Lyra, right? Yeah.
So you guys had essentially done the original AMM, and I was really interested by this. So I started building education videos in general for our channel, just because options are pretty niche and not everyone understands them. And the AMM was such a kind of revolutionary concept for spot markets, but it doesn't apply as smoothly to derivatives markets or convex products. And so Lyra had a really interesting solution for that in terms of the AMM, and you guys would hedge, the underlying exposure. You calculate everything in 30-day Vega and things like that, and take offsetting positions, and it was so genius. I was really impressed by it. So I really kind of dug into all the mechanics of it and did a video around how that works. And I think that was a fun experience and really educational.
Yeah. No, I still remember watching some of the videos back in the day. I was like, ah, yes, someone gets it. So, um, I mean, knowing what you know now, and it's, coming on to 2026, like, do you see, I don't know, we get this question all the time, like, is the AMM coming back? Or, like, are we going to go back to AMMs? When are they coming? Like, do you have any thoughts on option AMMs in the not too distant future?
So I think AMMs have a very interesting value prop that central limit order books do not. And I think the value proposition is from a liquidity provider standpoint, where you can essentially fund AMM and be a passive market maker. Obviously, a lot easier in spot markets than it is in convex markets. But I do think, in my mind, the solution to uh, a continuous altcoin offering where it's all sort of like a bespoke option demand that's sporadic, that's not big in size. I think about, if you want to trade options on some altcoin, you need, in a central limit order book style, you need someone to like dedicate resources to making a market for that. And if the flow is so thin and inconsistent, it's not worth it from the market maker's perspective to do that on such a limit order book. So then all that's left is like an OTC offering for those types of markets. But the OTC has its own limitations in terms of size, onboarding, things like that. The AMM to me is like the OTC product of the on-chain world, where it's this pool of capital that's willing to quote anything, so to speak, and in any size, because it's not like human run. So once it's deployed, it can continue to do those quotes. So in my mind, that's where the exotic optionality will the counterparty for exotic optionality will be an on-chain AMM of some sort. That I think that's how I view it in the future vision, but who knows?
No, that's really interesting. Like, God, I'm gonna steal that phrase. I forgot what was it that you called it? Like the on-chain version of an OTC desk, or
Yes.
I'm gonna steal that line. That's a good one. Yeah, I feel like I hear you. Like, we've been trying and thinking of launching alt markets for a while. Recently we just launched our hype market. Um, Getting liquidity for these things is a difficult task. And so it sort of does become a chicken and egg problem, right? Traders don't want to become because there's bad liquidity. Liquidity doesn't want to come because there's no traders. So bootstrapping it with some kind of AMM model, which you sort of see done on, like, Hyperliquid and, HLP and all of that stuff. Like, maybe there's a lesson to be learned there for, yeah, you know, bootstrapping these alt option markets, because it could be quite interesting. Um,
Mm-hmm.
from our experience, though, just like doing it all on the smart contract layer, like, a little bit of history, like, upgrading the contracts to go from V1 to V1.1. Like V1, I don't know if you remember this, like the original one was like everything was fully collateralized. The AMM, I don't think hedged, so it would take on some delta positions. It was very much a proof of concept, and obviously, fully collateralizing your puts, or having to covered calls, like, it's not particularly fun. Just upgrading that took like months of smart contract effort and then a lot of money auditing it. So point is, like, AMMs are like pretty hard, but, like, I don't know, short dated alt options, you know, if you do it modularly, that actually could be quite interesting. So
Mm-hmm.
yeah, I'm gonna think a bit more about that. Speaking of alts, market hasn't been doing too hot lately. Do you see us moving into a bear market, or what are your thoughts with where we're at right now for the majors?
Yeah, so I think I've talked about this a lot in terms of like what's the broad picture. I still think it's like debt super cycle in one word or two words, I guess, three words depending on super cycle. I don't know how many words that is. But the debt super cycle is still like this underlying theme, and a lot of people view that as a bullish theme for crypto, the debasement trade. The whole world and Western world in particular is extremely in debt. if you keep issuing debt, there's quite an incentive to essentially inflate away the value of the currency. And so any hard asset, whether that's gold or Bitcoin or real estate or anything tangible like commodities, will be worth more dollars or more said fiat currency. So that's one side of it. But then there's still the other side of it, which is, how does a debt supercycle unravel? What happens when you can't refinance long dated paper at reasonable rates? What happens as the yields on long dated government bonds rise, start to bring up yields on medium dated government bonds, and then essentially the governments start to refinance at shorter and shorter and shorter and shorter dated expirations on the capital stack, and then going from back end to the short term, yields keep rising, so on and so forth. At some point, the central bank has to be the buyer to keep that very short dated paper yield reasonable. But along the way, there's things such as like the equity risk premium or anything that has a cost of capital to it. To me, that's pretty bearish risk assets. So if we have any sort of destabilization in global bond markets, that's quite a bearish narrative. It's still part of the debasement thesis in a broader term, but I think there would be kind of destabilizing pain along the way. And what I look at, to me, is Japan. Japan is the number one player that's farthest down this road in terms of the debt supercycle, or what I call the debt supercycle. They had their real estate market crash 20 years before the U.S. real estate market crash. They invented quantitative easing. They had this huge deleveraging, deflationary debt spiral, you could say. And as interest rates went to zero due to deflation, they just layered on more and more debt in order to sort of stimulate the economy. But once you've layered on so much debt at essentially zero rates, well, what happens when rates start to pick up because there's global inflation? And so that's where I think we are right now. And that's why we're seeing 30-year bond yields in Japan rise a lot. Now 30-year bond yields, I think, are 350 basis points. They were 90 basis points not that long ago. The 10-year is 170 basis points. It was 50 basis points not that long ago. And so those yields are rising, but the yen is also losing value along the way. So it's not having the counterbalancing effect. So I think that's the wild card that I'm looking at, is the destabilization from a debt supercycle. And I think that could bring risk assets as a whole down lower. Let's think about, just real quick, like the U.S. equity narrative, all led by tech and AI stocks. Well, this tech and AI rally, to my understanding, I'm not an expert here, but it seems like it's discounting a lot of growth that has to be funded by capital expenditure and investment. And there's like trillions and trillions of dollars of demand that we're going to have for funding all that capex. And so now you have indebted governments that need credit. You have companies that are building out AI infrastructure that need credit. And then you go down to crypto chain and you have companies who are building out digital asset treasuries that in some part are using equity sales, but in other parts are using credit as well. So let's see how this plays out in a credit crunch environment.
So the worry is like everyone is so levered up in debt, countries, companies, like tech companies, but also now crypto companies. So if rates go up, which you're sort of positing that they will, then everyone sort of starts having very large interest payments that they're going to have to contend with. And then that's going to cause everyone to de-risk, everyone's going to have to sell. It's not going to be a pretty sort of environment for people. That's sort of your central claim there.
Yep, exactly. And just to tease out that last bit, if rates go up, there's a distinction between long dated paper and short term overnight rates. Central banks control overnight rates, but long dated paper is controlled by the market. And so you could get a situation where the central bank cuts, but long term rates actually go up. You have essentially a bull steepening effect where it's bullish for short term paper, but bearish long term paper.
Gotcha. No, no, that's not great for my my ETH holdings right now. But no, I hear you. I hear you on that. I guess like for now, like how do you contend with things like what happened yesterday with what was it, Project Genesis, right? Like the U.S. government is going quite heavy on like supporting a lot of these AI companies. Is there like the claim that for things like the Trump administration that they are just going to turn the money printer on and they are going to sort of, I don't know, do a bit of QE, especially with the midterms coming up. They're going to try and make the economy run super hot because that'll probably improve their electoral chances. Like short term, could we see prices go up, or are you bearish on that as well?
Yep, I think that's a great sort of catalyst short term. Everyone wants to get positioned for end of year rally as well. We've gotten a price decline for that as well. So I write a weekly newsletter on crypto vol and what I think is happening. And to me, like this week was a great long week because as something as ridiculous as it just being Thanksgiving week um, is kind of a catalyst on its own for the crash, like retrace a little bit. The crash that we've had over the past couple weeks from 120 Bitcoin down to $85,000 Bitcoin. And so short term, I think those are great catalysts to bring up. And I'm also not convinced that the debt super cycle isn't bullish because, as you say, maybe the response is just money printer go burr, and so if that's the case, things should go up. But it's still an area that I want to watch because if international investors or whoever decides we don't want to own U.S. Treasuries or the yields on Japanese interest, Japanese long dated bonds go so high, and then at some point like the paper can't be refinanced in a value that makes sense. I think you're going to see some sort of destabilization in global credit, and so global credit is a bigger market than equities, and both are much bigger than crypto. So it's just something to keep in mind. And sometimes, in order to get the debasement trade, you need the crash part. If everything's going well, you're not going to get the QE. You're not going to get the COVID money printer go bird. You need the sell off to trigger that part of the next phase.
Like, can you step? Like, I'm very interested in this. Like, so yields on long dated bonds are going higher, right? So that's people pretty much expressing the opinion that the government's ability to pay off its debt in the long term is like less and less likely, so it's attracting a higher yield. Um, Under your
Or
sort of
inflation,
debt,
yeah.
yeah, on your like debt super cycle, like people talk about where you know government debt becomes like debt spirally, right? Like I think it's when debt is like 120% of GDP or something at 140%. And I think the US now is at 110, maybe 120. Like, what does sort of the breakdown look to you? Like, how, I mean, obviously it's such a catastrophic event, but like, does the US just sort of default? Or like, I know that earlier in the year, the US government was talking about, you know, getting people to buy into like 50 or 100-year bonds like with NATO countries, right, in exchange for providing NATO protection. Germany, France, etc. would all buy like very long dated US treasuries, and that could sort of stymie a lot of the issues on that front. That's like one option. I guess people are talking about like inflating the debt away, so like that's part of the claim of the big beautiful bill as I understand it, right? Like you're adding like $3 trillion to the government debt, which sounds pretty bad, but the idea is that like it will pay for itself in terms of the economic growth that it will stimulate. Also, like Trump is clearly trying to install a loyalist in May. That person is probably going to be putting rates lower. Lower rates will mean probably higher inflation, then the value of that debt relatively goes down. Like, are those like valid solutions, do you think, or is there something maybe more galaxy brain that we're all missing?
I like the term galaxy brain. That's pretty cool. So just real quick, when we talk about like the debt to GDP ratio line in the sand, call it 140% or maybe 160%. Japan today is 250%. So it is so far ahead. You got to think about, well, what is the terminal endpoint? Like, how much debt to GDP ratio can you layer on? And so if you think about a terminal endpoint, if you look at total taxable revenue, um, so, whatever, let's say the GDP is $5 trillion. Well, how much of that $5 trillion is collected as tax revenue? So let's just say it's like 12%. So then at 250% debt to GDP, that means essentially if rates are, call it, a little over 4, or call it 5%, well, at 5%, 100% of tax revenue cannot pay interest alone. So that's what the terminal endpoint is. So to me, that's the ultimate line in the sand, where 100% of your income cannot pay just the interest portion of your debt service. That's done. So how does that play out? So I think what's happening now is that the obvious end game is some sort of inflation. I think it's easier for the central bank to buy the debt from the open market and then cancel it from their balance sheet. That's called debt monetization. It's different from QE, because QE is you inject liquidity, but with the implicit promise that as the bonds mature, that liquidity comes back out of the market. So it's not destructive to the fiat currency in the same manner. But if you just buy debt and extinguish the debt, and that liquidity is forever injected into this system, and then there's no sort of guardrail on, well, why don't we just keep printing infinity money to finance all our pet projects in terms of deficit spending? And then you get sort of the Weimar Germany, wheelbarrows full of money to buy a loaf of bread. So that's the ultimate debasement trade. The issue there is that, in my mind, it's easier to do debasement than it is to default on portfolio holdings. Now, in the case of Japan, I think Japan is something like 85% owned by domestic investors. So I think the default equation is a lot less likely, because you're essentially going to default on debt, which hurts your own sovereign government, sovereign citizens' holdings, which in turn hurts the wealth effect, which in turn hurts the economy, blah, 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 blah. And now you're back into this deflationary scenario. In terms of the US, I wouldn't be surprised if we get some sort of geopolitical wranglings, and then, hey, we don't like these guys who own a bunch of our debts. They haven't been playing nice, so we're going to default specifically on China and their holdings, and all those QSIPs are no longer valuable. That's more of a scenario I could see in the defaulting world. But I think what's happening in the long dated paper, it's not that investors are afraid of a default. It's more that investors know from now until 30 years from now, there's probably going to be fiat debasement along the way. And so the value of the principal that I'm getting back in 30 years is worth basically nothing to what it's worth today in present value terms. So I think that's what's going on. In terms of the path, which is the path of the debasement along the way, I still think what happens is you get some sort of rumblings along the way that spook risk assets in order to get central banks more involved. So what I think that looks like is that, let's just say 30-year paper in the US has no demand on it, and all of a sudden the yield is not 480 basis points, it's 900 basis points. Well, that move would be scary to risk assets. And so I think because that move would essentially trigger risk assets to drop, then you would get the let's cut rates or do some more QE or whatever, buy corporate bonds or buy MSTR stock. Just kidding about that last part, but you know what I mean. Like the central bank would get more involved on the money printer go burr, and let's allocate that money to random places, or send direct checks to citizens or whatever it is. And so I think that would be the catalyst for debasement to occur.
So, like, I'm guessing, because you mentioned it, like, what you mentioned was interesting, right? If those, like, super long dateds go to become, like, 900 basis point yields, then, like, that's extremely worrying, right? Like, that's probably going to cause a massive sell-off, and then that sell-off is going to trigger like central banks and all of that to start, borrowing out money and handing out steamy checks, basically.
That's what I think. Yeah.
Gotcha. No, no, that's all very interesting. I guess do you see this playing into anything? I know like one other question I had was like, people talk about these like 4 year cycles for Bitcoin because of the halving. Does that play any role as well in sort of your thought process, or is that sort of obviously like the stuff with rates that's much more macro, but like maybe sorry to refine my question, like do you see on a separate note, do you see the 4 year cycles that we've seen historically? Do you see those continuing, or is that trend dead?
I mean, if you would have asked me this in August, I would have been like, don't pay attention to that. It's too predictable. Everyone knows the 4 year cycle thesis. Like, I don't think that has any value to it anymore. And then it just played out essentially like to a T. um, so, ate my words. I don't actually know, but I'll say I'll defer to the trend is your friend on this case. I mean, the 4 year cycle has been working nonstop, and I guess that's just how the world works.
I remember there was like one Twitter post of someone. I mean, I'm sure there's plenty of them. Like people pointing to, oh, like it was this number, like X number of days from the halvening to the next all-time high, and then it was another Y days afterwards until it crashed like 60%, and then yeah, people did that for this cycle, and I think it was pretty. I think they were off by a couple of weeks to like predict the October November crash, but yeah, scary stuff. Um, I don't know, like how many data points are there now? It's like four halvenings that have caused crashes, maybe three. Um, I don't know if we count this one yet. Um, I don't know, there's something to be said, right? Like Bitcoin obviously is what drives a lot of the industry. If it halves, like the amount of emissions halves, it's going to affect some people somehow. That'll probably change the dynamics, but I don't know. To be honest, like I've also maintained your position of like, it's just a trend. Like, you can't just rely on this thing historically, but somehow it is uncannily accurate. So, I don't know. Don't tempt fate is maybe the lesson here. Um, Speaking of like, we talked a bit about like the macro stuff. How do you see like DeFi developing as we go on? Like, is it going to become this new burgeoning financial system, or is it going to remain a casino for the next couple of years?
That's really interesting because there's kind of the DeFi protocol side of the world that we've lived on for so long. And then there's kind of like the Web 2 transition into Web 3 via stable coins, DeFi side of the world. And I can't help but think that digital dollars or digital money to like shop on Amazon or whatever it is makes so much sense. Like instead of having my credit card loaded up to Amazon, I could load up my quote unquote MetaMask with my credit card, and then I just have cash in this Web 3 world, and somehow there'll be a bridge to Web 2 world, and now the internet just has money in it. And to me, that makes a lot of sense, and I think that's probably going to be the next phase of DeFi is traditional commerce that just incorporates stable coins and traditional sort of banking that now takes a step towards the Web 3 world. Um, I think that's kind of how I'm seeing it in terms of cool DeFi protocols. Like Derive with central limit order books and stuff like that. I think the people who have always lived in crypto will be the participants in that world. But in terms of the non crypto native who is somehow going to bridge into crypto, I think they're going to be getting here from a more familiar path.
Yeah, absolutely. I mean, what you mentioned about the stable coins is like quite interesting as well. Like, you know, you hear these stories in like say like in Vietnam, The Vietnamese dong isn't exactly the strongest currency. You can't very much buy stuff with it. I think it's going through a lot of inflation. Um, I think as well, like a lot of people in Vietnam like to hoard US dollars. But the problem with hoarding US dollars is that like you can't deposit them into a bank and earn interest in Vietnam. So, you're holding this money and you can't accrue interest. So I think there is like this huge demand in countries like Vietnam, but also other like, Southeast Asian countries to acquire stable coins. Because then, well, you can go do stuff with them and earn money, right? You park it on Aave, you earn a couple of percent. So like it seems like stable coins is like the product right now that has definitely accrued some kind of product market fit. Um, I agree with your point as well that like, you know, for me, like the litmus test would be sort of like my parents, in terms of like
Hmm.
how I see them getting involved in crypto. Like my parents are never going to use Uniswap in its current state. I think my mom asks me about Bitcoin every couple of weeks, and that's pretty much it, right? And I think that's pretty much the average person's exposure to it. So these people will come to crypto eventually. That's obviously the thesis, but I think for a lot of them, it'll be, you go to your bank, you might buy a stable coin at your bank, and then you might deposit it somewhere, and that might be using smart contracts. I think that's, um, I hate to use the term, but that's sort of like the normie idea for the next couple of years at least. So yeah, broadly, I agree with that.
Yeah,
Um,
100%. It's kind of like, when do computers take off? Well, they take off when we don't have to use the command terminal line and we have operating systems and click around. And so,
you're never going to make anyone feel safe if like they're like, oh, I think for a lot of people they take solace and comfort in the fact that if I do as well, right? Like if I like get locked out of my bank account one day, it'll be shit. But like I could always go to the bank, I can always go prove my
yeah. Yeah.
identity. And I know people like my parents would never feel comfortable with like their only recourse is 12 to 24 words that they have to
Yeah.
store in a safe somewhere, and if like their house burns down, like, well, tough luck. I think it's going to be hard until like that UX improves. I don't know, maybe there's some magic wallet technology. I know there's like multi-party signatures and all of that stuff, so maybe that's a thing. But that's just not widespread now, so um, I think until we get to that point, it'll be a hard ask for a lot of people. Um, I know people as well who trade crypto, and they trade on things like Binance and OKX. And for them, the idea of like self custodying the stuff is like almost a foreign concept, despite trading crypto. So it's quite interesting to see that.
Mm-hmm.
But yeah. Speaking of Binance, though, like where do you see derivatives going in the space? Like obviously, perps have a stranglehold on stuff so far. Um, do you see that trend continuing, or do you see like options and whatever else rising in
Yeah. I mean,
prominence?
the growth in options that we've seen over the past year has been incredible. So, since January 2023, open interest for options markets has gone from, for Bitcoin option markets, has gone from 5 billion to 80 billion. And 40 of that 80 has come from IBIT, the BlackRock ETF options. And the growth has started since August, like the parabolic growth. So, long story short, is the open interest in the options market is growing parabolically, and it's really led by the ETF, um, the IBIT ETF, and the options on that. So I think we're going to keep seeing that. That makes a lot of sense to me because you have centrally cleared options. You don't have this risk. Deribit's been great, but I'm thinking about like other exchanges where you're trading perps and stuff like that. Um, you get auto liquidated out of um, your hedge. How can you make a market on that? How can you make a market if you don't know what the other side of your trade is? If I'm making markets on Binance and I'm making markets on Bybit and Deribit and blah 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 blah, well, if I get an auto deleverage on Binance, but that's hedging my Bybit, and I'm sort of stuck in the middle, and now the one hedge that's saving me gets pulled away from me, and now just riding along the other side doesn't work. Um, and so I think there's a risk there that traditional finance has solved already, and market participants feel comfortable with that solution. So that's interesting. I also think traditional finance, they have all their margin located in one place if you're trading IBIT options. And so you can trade some IBIT options, you can collateralize that with some, you know, long stock somewhere else and blah, blah, blah. So it becomes very interesting. And then lastly, you have the growth in traditional finance option has on its own been parabolic. So forget about crypto options trading growth, but just traditional options trading growth in the whole entire equity space. So we're looking at the growth of the growth, so to speak. So yeah, I just think options on crypto continue to lead. I think today, open interest on Bitcoin options versus open interest on perps and futures is neck and neck. I'd have to look at the numbers recently, but it was pretty much about the same. That says a lot because, as you mentioned, perps has been the vehicle of choice for trading in crypto, and options actually not so much. But today, um, it looks close.
No, for sure. You mentioned about IBIT options before. Like one thing I was curious about is I think the vol for IBIT options was trading at like a pretty significant premium to like Deribit vols. I don't really have a good answer to why that's the case. Like my naive guess would be like people who are trading IBIT options, there just aren't as many vol sellers there. So naturally, that just creates a premium for vol for the buy side. I honestly don't have a better answer than that. I don't know if you've got any thoughts on that.
So even I've checked it a few times as well, and there's a little bit of a, we're looking at Black 76 versus Black Scholes. What's the input on the interest rate model into the Black Scholes? Blah, blah. You could fudge around that a little bit, but it shouldn't really matter that much. Even if IBIT and Deribit are equally priced, it's my opinion that Deribit options should always trade at a premium to IBIT. So whenever IBIT is trading at a premium to Deribit, to me that is an edge. And the reason why I say that's an edge is because just like we saw with the I think it was October 10th liquidations that occurred, or November 10th, I forget, the tariff tweet, and we got the auto deleveraging and all that craziness. And we saw perps markets trade prices that were, say, 75% lower than the corresponding cash market. So if I look at SUI USD on Coinbase versus the perp for SUI USD, there's a 75% differential. There's more volatility in the perps market and the futures market than there is in the cash market. And one of the things to keep in mind there is that if that volatility was like randomly distributed, then you couldn't make the assumption that that volatility necessarily creates a volatility premium in the options market, because sometimes the volatility might counteract a move. But in crypto, the volatility is positively correlated to spot. So as spot rallies, basis expands. As spot crashes, basis contracts or goes negative. So it's always correlated to the path of spot prices. So what that means is you always have a premium in terms of realized volatility of the futures market versus the cash market. And so if you're trading options on Deribit, you're trading futures options. And we've seen this especially pronounced in crashes. So COVID, FTX bankruptcy, SVB banking crisis, kind of those big moments. The realized volatility from the basis compression or inversion of the futures market can translate anywhere from plus 10 points, 10 vol points, all the way up to, in the case of COVID, I think it was something like 45 vol points. And so IBIT is essentially a cash instrument, spot Bitcoin. There's no leverage liquidations risk that pushes the market. There's no embedded basis into the IBIT market. So to me, those are options on a cash instrument, whereas derivative options are options on a futures instrument, and a futures instrument or the forward can often be largely positive and flip into negative as the market crashes. And so I think it's edge. I don't know why it's priced the way that it is. I would take the other side.
Yeah, no, that answer makes sense. And like the trade there, right, would be in that case like short the IBIT, long the derivative calls or the derivative options, right? And so you'd make
Yep.
whatever that vol differential would be. Oh, okay, no,
Yep.
nice. No, that makes sense. Now speaking of like the ETFs, like how do you see do you see ETFs impacting options flow as well? Uh, is there any connection there?
Yeah, I think the ETFs are the driver of options flow. I think they have been for IBIT over the past year. So we have a structural decline in volatility of Bitcoin, especially the implied volatility. So there's kind of two components there. How volatile has Bitcoin been? Well, it's been less volatile, but then how much of a premium does implied carry versus realized? So that's a variance risk premium. So one component is Bitcoin maturing itself and becoming a more established asset class with a higher market cap. The other component is really the differential between implied versus realized, which is really driven by flow. So we've seen a compression in both. And the compression on the variance risk premium, in my mind, makes a lot of sense. As these markets have more participants, it becomes more efficient, and you have less moments of essentially FOMO rallies or panic crashes, where realized can outpace implied by a lot. It'll kind of trade along the way in a less binary fashion. So that makes being short vol less dangerous because there's kind of liquidity to get out along the way, so to speak. So that's one thing. The other thing is the people who are buying IBIT are kind of traditional asset allocation investors. I'll buy some IBIT for the portfolio. I get some diversification risk, call it 2 or 3% of my portfolio. I'm going to sell the covered call because Bitcoin doesn't yield anything. And so the source of income is the call that I'm selling anyways. And it's a 40 vol asset. So that premium is actually kind of juicy. And so there you go. Now you have an overhead supply of consistent paper for vol on the call side. And then on the buy side, you got those same people sometimes buying the protective put. And so that has two impacts. It kind of offsets the absolute vol impact. We've seen that. We've seen the skew kind of shift more negative, especially for those long dated 6 month options, so on and so forth. We've seen implied volatility come down. But on the realized volatility side, if the people who are the major owners of the ETF are no longer going to be panicked sellers when the market crashes because they own the protective put, I kind of think that has a stabilizing effect as well. So, anyways, those are kind of my thoughts around the realized component of that and then the implied versus realized relationship.
No, that makes total sense. Like we've been talking a bit about Bitcoin. Obviously, that's a lot of the driving force here. Like, what about for the other like Altel ones? Like, so obviously you got ETH, Solana, Sui, Aptos, that sort of thing. Like, how do you see those spaces evolving in the next 12 to 24 months?
I'm not sure actually. I don't have a good answer. I don't have my finger on the pulse of like the development side so much. I think kind of bird's eye view from my perspective, I kind of just look at the options market and the vol side. But I think one place that I seem to think will do really well is essentially the stable coin side of it, which seeing Circle go public, I think I don't know, that stock, I like it, especially on the option side. It's a high vol asset. There's interesting asymmetries to be done there. So I see that developing more.
That makes sense. Um, you've touched on MSTR before. Any thoughts on the DATs, specifically MSTR?
So I think the DATS ecosystem, you have to we have as traders to keep a tabs on it. I think the average purchase price for Bitcoin for strategy has now been around 74,000, if I remember from last time I checked. If I look at BMNR or SharpLink or or ETHZilla. I mean, they're way underwater on their ETH purchases. I think there's 3,600, 3,900 purchase prices on ETH. So what I keep thinking about is, as prices go down, do these DATs become like overhanging supply as the market tries to rally back? Like, is that are they just going to be rebuying and cost averaging at lower prices, or are some people starting to regret their digital asset treasury holdings and board members forcing management to lighten up and all of a sudden your company's a hedge fund when you're running a software business or whatever it is. Um, just something to keep in mind. I'm not really a big trader of these, but I keep in mind.
No, it makes sense. Got a few questions as we wrap up, just from community members. So, from Alvaro, what do you think is the missing piece for mass adoption for options on chain?
That's a good question. I think there's a few things. One is just onboarding on chain is just a more niche subset of users. I think market making is, finding market makers to make markets is kind of a niche counterparty user. I keep coming back to the AMM. I think the AMM solves half that equation pretty nicely. I just love that it's it's a brand new thing. Um, I mean, you guys did it before, but like it's a brand new thing in a lot of ways, and I think it solves a lot of the on-chain problem, just like it did for spot markets.
Oh, nice. Um, and then his other question is, what advantages do you see for on-chain options over traditional venues?
Yeah, I think the main advantage is flexibility. On-chain venues can try optionality that you can't find anywhere else in a way that's more efficient, more experimental, allows more types of products. Yeah, I think it's going to be sort of the pioneer. Let's think about traditional finance. Traditional finance thinks that, having a Litecoin future is the next iteration of the crypto market. Who cares about Litecoin? There's so many steps behind that, like, we haven't been talking about Litecoin since like 2014 or whatever it is. So I think the more you go to the traditional infrastructure stack, the more delayed you are in sort of the nascent trends. And then on the flip side, for DeFi, um, you're the cutting edge of what people want to trade and the innovations that are being developed. I mean, it'd be cool to trade, I don't know, hash rate options or something like that. I don't know. There's weird things you could trade
Gas
out
price
there.
options, right? Like that sort of thing.
Exactly.
Yeah. No, that makes sense. I think one question was on like transparency as well, right? I think crypto obviously is fully transparent. That's a lot of the value prop. Do you think that, going back to the institutional side, do you think they will value that, or will they eventually want to build in this concept of like dark pools or like a more opaque walled garden?
I think transparency is going to be I think transparency is the trend overall for like humanity. If we think about like the internet and writing books and the printing press and television and blah 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 blah, and learning how to read. I'm pretty sure for a longest time you couldn't read like your religious text, and only like certain appointed people who knew the language. So overall, I think transparency is the trend is your friend. Don't fight that. And I think interesting sectors to develop transparency. If we go back to the stablecoin analogy of digital dollars or internet dollars, well, imagine just kind of like streamlining your entire um, 10K auditing process, because all the transactions are already on chain, and you just kind of like click a couple buttons and now your annual report is done. And there's a $5.5 million incentive to do that because you don't have to hire like all the accountants, blah 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 blah. That seems like a place of transparency, and I think that's going to be true for the corporate world at some point, but I think the on-chain DeFi world will pioneer that. We've seen that with DAOs, and we've seen that with governance voting processes and things like that.
Nice. Last question from Chinese followers in our WeChat group. What type of data do you think matters most for on-chain derivatives, for making on-chain derivatives competitive with top CEX venues, a la Derive? Maybe to broaden the question, right? Like, what would make someone more willing to enter like a place like Derive and trade as opposed to a more centralized venue like Binance? Though I think you might have already answered that.
Well, I think a few things. It's maybe not completely data related, but the RFQ system is very nice. I know that was a big Paradigm was a big driver of growing volumes for Deribit via the RFQ infrastructure. That's an interesting data set, getting quotes for prepackaged deals and stuff like that. I also think having markets with quotes of last resort, because it kind of sucks, like if you call the market right, the market crashes and then there's no quotes for you to like cover out of your position, because market makers have all pulled back. I think another plug for the AMM, but I think that's an interesting use case. But yeah, I would say those two. In terms of raw data, I mean, just a classic, we need WebSocket data, GET requests. This is more like my side of the business on the data side. We listen to trades and top of the order book tickers via WebSockets. If we ever miss something or a collector goes down or blah blah blah, we can call the feed via GET requests. And Derive has done a great job. I mean, you guys have a really good API and SDK for pulling all the data. And then it makes our job a lot easier to just essentially normalize it, calibrate it, make a surface, and compare that to different venues.
Nice. Well, I think that's all the questions that I had for now. Thank you for joining us today, Greg. Really appreciate it. It's always fun chatting. Yeah, just before we go, do you want to plug any social media of yours?
Yeah, absolutely. Well, thanks again, Sean. We're really happy to be on. If you want to check us out, you can go to pro.amberdata.io. You can check out some of the tools there to monitor the crypto volatility markets. You can also get our weekly newsletter, which gives us a market wrap around crypto vol and what's going on and what we think is going to happen next week or the following week. That's amberdataderivatives.substack.com. And then lastly, you can go check out the website at amberdata.io.
Awesome. All right. Well, thanks for coming on. It's been great chatting, and yeah, chat soon.